So you guys heard that I worked at McKinsey, and you probably are expecting a bunch of slides, but I'm not going to kill you by PowerPoint, I promise. I may kill you because of my voice being difficult today. I'm suffering from a little bit of a cold, so bear with me. Thank you for having me here. It's really an honor to be here. It's really exciting to see so many schools come together and talk about climate change and how it affects business. When I was in business school 14 years ago, or 13 years ago, I guess, I was the only person in my class at HBS that was talking about clean tech. It was a little bit before the big hype cycle that followed. And I was asked to come here today and talk to you guys a little bit about my journey and how I got to be the CEO and co-founder of a firm called Generate Capital, which I'm really proud to be a part of, and is doing a lot of really exciting things around climate. And it did start, 14 years ago when I decided to go to Harvard Business School. I had spent over a decade in technology as an entrepreneur and a venture capitalist. And I was sitting in London, where I was living at the time, and thinking about next steps as we were about to sell my last technology company to Hewlett Packard. And it was sort of existential, right? It was very introspective time for me, trying to figure out what I wanted to do. I did not necessarily expect I wanted to go to business school. My father actually had an MBA, so I was really not interested in having an MBA. But it was clear to me that I wanted to make a pivot, and I wanted my life to be about something other than making labor free, which is really what software is all about. And so as I thought about the things that mattered, and I really thought, what will define our time on the planet? It really came down to sort of three different topics for me. It was about access to opportunity, and maybe getting involved in education or education-related industries to think about how to bolster and make more equitable access to opportunity. The second thing I was thinking about was healthcare and wellness, and sort of how we could make more equitable and increase access to wellness and health across the world. And then the third topic to me was the intersection of geopolitics, energy, and the environment. I had friends who were going off and fighting wars in order to protect our oil supplies. Fortunately, they all came back, but not everyone did, as we all know. And I was an international relations major in college, so I spent a lot of time thinking about war and conflict and macroeconomics and geopolitics. And it was really clear to me that if you look at sort of the course of human history, most of the major conflicts that we have seen were over resource discrepancies. Energy, water, food, land, access to transportation or goods shipments. And so I really thought, gosh, that's still an issue. And I thought very naively, what if we could make those resources free? Maybe we'd stop fighting wars over them. We made labor free, right? I was just talking about that with technology. We literally do not need another human to ever enter the workforce to create the same amount of economic output, thanks to technology. What if we could make it so that energy was free, that water was free? Is there a way to innovate around these resources such that we would avoid these kinds of global conflicts down the road? So that was very naive, as I will return to over the course of my comments. But I initially thought, I'll take my Silicon Valley technology, venture capital background and apply it to energy and resources. And there were a couple folks doing that at the time. Kleiner Perkins, you guys all know Kleiner Perkins. They're probably the most famous venture capital firm in the world. They invested in me, back in 99, 2000, and I had a gentleman named Vinod Khosla on my board, who was also one of the loudest speakers about the greatest economic opportunity that's ever existed, which is clean tech, or what they were calling green tech in 2004, 2005. So I joined up with another venture capital firm called Sequoia Capital, also pretty successful little firm. They were the ones behind Google and YouTube and Network Appliance, Oracle, and others. One of the most successful investment firms ever. And while I was at HBS, I did a project for them. And I came to the conclusion after about 6 months, much to my own chagrin, that the Silicon Valley model of entrepreneurship doesn't actually apply to energy and resources. It's completely a misfit. Sequoia has successfully delivered incredible returns over 35, 40 years by following a very simple formula. Small amounts of money, going to small teams, who in short periods of time create big revenues, big margins, and big exits. You get a really great return for the risk that you take by getting involved in an early stage company. And so as you think about those 6 criteria and you apply it to energy and resources, you come up with 0. So I was a bit of a pariah in Silicon Valley, where I grew up and where I had my first career, saying, this ain't gonna work, folks. We're gonna lose our shirts. I told Sequoia to run for the hills. And the reason is that energy and resources are not a game of invention. They're a game of infrastructure. The only way we ever get to use resources, really, is via infrastructure. We get electricity from the grid. We get water from the grid, effectively, right? We get food through systems. But we're not, we actually are inventing food now, which is another concept we can talk about at some other time, maybe tonight over drinks. But energy, water, food, land, even air are critical economic inputs to the economy, and they are only available to consumers primarily through the infrastructure that we have built or that we will build. And so if instead of an invention game, it's an infrastructure game, who are the key actors? Big companies, big capital providers, big governments. That's not Silicon Valley's bailiwick. So I said this thesis to someone who was visiting HBS, who ran the energy practice for McKinsey. And he said, wow, that's really interesting. Where better than McKinsey to influence big capital, big corporate, big government? And we could bring your innovation understanding and your entrepreneurship understanding and plug that into our platform where we are already advising all of these big clients. And I was pretty skeptical, because McKinsey was about as non-entrepreneurial in my mind as it could be, right? They work with big companies, and I'm like this weird entrepreneur. But I got an opportunity to start the clean tech practice with a couple of partners back in 2007, and it was definitely a great decision. The promise of the platform played out. We, within 2 years, mind you, in the middle of the Great Recession, did 500 clean energy engagements from 0 2 years earlier. It was the fastest growing practice the firm has ever launched. Hundreds and hundreds of millions of dollars worth of revenue and hundreds of millions of dollars of profit. The reason we were successful was because we framed these issues in terms of economics, not in terms of policy compliance or altruism, which is where green has always resided. And if you think about the scale of the problem, whether it's climate change, resource scarcity, food insecurity, water resilience, these are trillion-dollar problems, each. If you look back in the history of all philanthropy across all causes, over the entire human existence, we haven't done $1 trillion worth of charity, okay? We're not gonna get $1 trillion for each of these things to solve these big problems. I have been schooled that markets can solve problems. You guys are all doing that right now. I think you probably believe that, although there are clearly problems with markets and there are clearly problems that can't be solved by markets. But we frame these issues at McKinsey as credible economic advisors in a way that allowed people to understand it was absolutely about their rational self-interest to pursue these solutions to these big problems. We served pretty much every Fortune 500 CEO that you know about doing green stuff. And it wasn't because they wanted to pat themselves on the back or feel better about themselves. It was because it was about the top line or the bottom line. There aren't many growth vectors in the economy. This was one. There weren't a lot of cost savings opportunities because McKinsey and others had been very successful helping them lean out costs. But this was a huge cost savings opportunity for them as well. So top line, bottom line opportunities. We advised 41 heads of state while I was there. And it was about their rational self-interest too. Leaders of governments care about economic competitiveness and they care about national security. There's not much more important to those two topics than energy, resources, and climate change. We successfully convinced those folks too. Many of them didn't need convincing, fortunately. Most of those people are not in the United States, or DC at least. And the other big actors, as I said earlier, are the capital markets. And so what was interesting is, as we talked with a lot of these CEOs or any of these government leaders, they would spin up new initiatives. They'd get really excited about ROI, but they'd need money. Money builds projects. Money funds initiatives. And so they'd try and go to the capital markets. And what would they find? Skepticism, misunderstandings, misinformation, politicization of these issues. The capital markets still believe this is just the realm of philanthropy or policy, not an area to make money in, not an area to mitigate risk. So I started spending a lot of my time in the capital markets, talking to pension funds, sovereign wealth funds, insurance companies, some of the biggest asset holders in the world. And I started talking to them about why they had this misinformation and why they didn't think this was a good risk-adjusted opportunity for them to pursue or to support these CEOs and these government leaders and these initiatives. And two things came out of that. And it's stuff you guys know. But the world is shorter and shorter term oriented. We're trading in milliseconds on the stock markets these days, right? We care about quarterly earnings. Our government leaders are on 2-year election cycles where it basically is always a campaign. These short-term mindsets make it very difficult to solve long-term problems. The incentives aren't there. So short-termism was one thing that came out very clearly as a barrier. And the second thing was the siloization of knowledge, the siloization of how we organize ourselves as we think about risk and opportunity in the capital markets. What I mean by that is if you're an investor, you kind of break up the world into asset classes, sectors, and geographies. Asset classes like fixed income, equities, alternatives. Sectors like energy, technology, agriculture, et cetera. Geographies like North America, Europe, Asia, rest of world. Well, this issue we're talking about today, whether it's climate change or these other issues like resource scarcity, these are thematic issues. They don't care what asset class you're supposed to cover as an analyst. They don't care what geography you happen to be focused on. They don't care what sector you're in. You are affected by climate change. You are affected by water scarcity, no matter what. These are thematic issues. They're thematic risks and thematic opportunities. And the capital markets have no way of dealing with it. We still, 10 years after the global financial crisis, manage 99% of our assets with this siloized model where we think that we diversify risk across uncorrelated asset classes, sectors, and geographies. We still think that fixed income, real estate, North America is isolated, and yet it blew up the entire economy 10 years ago, because it's not isolated. And climate change is one of these non-isolated risks. It's thematic. So it was clear to me that that was really what people were missing, this sort of longer-term mindset and a more thematic understanding of the issues. At McKinsey, we called it the resource revolution. It's about doing more with less of our precious resources. That's the same productivity equation that has propelled the economy for the last 150 years. The agricultural revolution, the industrial revolution, and the digital revolution, they were all about productivity. The productivity of the worker, right? As the Brits would say, that was the sticky wicket. The laborer, right? But as we've said, labor's free now. We've solved those problems, unfortunately, in some ways. It's a different social issue we may talk about some other time. But what we're talking about now is the productivity of our energy, food, water, and other critical resource inputs to the economy. We have not at all seen the same productivity growth with respect to those resources as we've seen in labor. And so the fourth industrial revolution is this resource revolution. And it presents all sorts of opportunities for people like you and me. And so when I was talking to these capital markets actors, they kept saying to me two things. Scott, we believe you. We're overexposed to risk. We're underexposed to the opportunity. What do we do, right? The two questions they'd ask after that are, where's the vehicle? How do we invest? How do we manage risk? What do we put money into to solve this, right? And number two, what's the benchmark? How do we actually analyze what we're doing in comparison to something else? Because we always have to benchmark everything. That's the only way we can actually understand whether we're doing well or not. So I left McKinsey to answer those two questions. I helped start a software company to address the analytics piece called Intersect, which has actually been something here in North Carolina. The company's based here. And then I started Generate Capital, which is an infrastructure investment firm. And as I said, this is about infrastructure, not innovation or not invention. But the business model of solving climate change is an infrastructure business model. It's projects. It's not Silicon Valley style entrepreneurship. And I partnered with someone you guys probably have heard of if you have been in the renewable space at all. There's a guy named Jigar Shah who founded Sun Edison and introduced third-party financing to solar about 15, 16 years ago. I met him when I was at HBS and we started co-conspiring all the way back then. But what his genius was is he said solar energy, this is 15 years ago, I think there was about $1 billion in aggregate deployed in solar historically at that point. He said solar energy is suffering from the fact that the people pitching it are pitching a $5 million project that saves $1 million a year. Well, in energy, people pay by the month, whatever they use. It's really difficult to say, let's spend $5 million now in order to save $1 million a year going forward. From my enterprise software days, this was the same pitch. We would be like, hey, let's charge $5 million and you'll save $1 million a year in labor. Like that was a really difficult challenge from a sales standpoint. So what happened? We started leasing software, and then something called software as a service came about. I actually was one of the first investors in Salesforce.com back in 1999, which to this day is still my best investment ever. Hopefully at some point I will exceed that. But software as a service solved this problem of letting people pay as they go for savings that they generate over time. And Jigar, when he saw that this was such a problem in solar, trying to make a CapEx decision for a customer, he said, why not make it an OpEx decision for the customer the way it's already an OpEx decision? I'll get Goldman Sachs' equity, Wells Fargo's debt, and build a project that effectively offers the same thing the utility is currently offering, which is pay as you go. That transition from CapEx to OpEx for the customer unlocked the solar market. We now do $300 billion a year of solar project implementations from $1 billion. Now, the capital markets will tell you that solar was risky as a technology 15 years ago, and that's why it was a niche. It's not true. That technology was 40 years old 15 years ago. It's now 55 years old. It's the same crystalline silicon cells that Bell Labs produced in the 60s that we're using today. There was not technology risk 15 years ago. There's not technology risk today. And across the resource revolution, there are opportunities like this, where the technology is perceived as risky, but it's not. My favorite today is something we're very active in at Generate, which you guys are probably hearing a lot of hype around, battery storage. It's lithium-ion batteries that go in the basement of a building, saves a bunch of energy for a building. Everybody wins. But bankers will say, oh, we've never done that. That sounds scary. Lithium-ion batteries in basements? And my response is, you've had those same lithium-ion batteries on your lap and next to your brain for the last 15 years, and you didn't worry about that, and now you're telling me it's riskier in the basement of a building? Not so much. So we're starting to see that, right? But what we do at Generate is we try to build a bridge to bankability, right? Infrastructure requires lots of money. The capital markets have to think it's safe. That means it can't be new whiz-bang technology, because safe and whiz-bang don't go together. This is infrastructure, right? It needs lots of money. So what we're doing at Generate is much like what Jigger did 15 years ago with solar. We're taking these proven technologies and we're turning them into infrastructure projects that are safe so that we can mobilize a lot of money and change the world. And we've done about $500 million worth of these projects over the last couple of years. And there's a lot more to do. But there are a couple key messages here. One, you don't have to be a Silicon Valley entrepreneur to be an entrepreneur in the energy and resources space. We need project developers, like real estate developers. We need really smart people like you guys to be putting projects together. And you can make a lot of money, just like Silicon Valley entrepreneurs, but it's just a different type of entrepreneurship. What you do is you find a site where it makes sense to build a microgrid, for example, or a wastewater treatment plant, or a sustainable agriculture facility, like an indoor farming facility. And if you're smart, you can figure out what things you need to use in order to build this facility in such a way that it's economic for the customer. Because you guys know economics. It's all about giving the customer something that makes sense economically. So if you put together these projects and you find customers who are willing to save money by using them, you can be a very successful entrepreneur in the resource revolution. And there are lots of other places to play in the resource revolution too. There are bankers that need to have an understanding of how the world is changing, who are willing to be creative and not just take the fastest deal, because that's usually the incentive, right? How do I close the deal fast, get my fees? There are consultants, obviously, that are all across this space. There are marketing people. There are business leaders. So anything that you all are thinking about from a career standpoint is probably applicable and relevant and a great opportunity to infuse some of what you're learning this weekend and hopefully what you really want to do from a personal passion standpoint. So I'll close with some unsolicited career advice. You probably think about three things when you think about jobs. You probably start by thinking, oh, I want to go into that sector of the economy. I want to be in tech, or I want to be in energy, or whatever. Sector, finance. The second thing you might think about trying to achieve is a function. You want to be a strategy person, or you want to be a finance person, or you want to be a marketing person. Right? So you got your sector, you got your function, and then you're going to care about your role and your comp. And that's usually the whole algorithm for most people. I'm going to challenge you to think a little bit more intelligently about this. because actually those three things don't matter compared to the next two. First and foremost, the people you work with. The people you work with will determine your happiness. I know you hear this every day from your professors, and it's all trite and whatever, but it's really true. And it's also the greatest thing about being an entrepreneur. You get to choose who you work with. And the thing, we've done a lot of really great things at Generate over the last couple of years, but the thing I'm proudest of by far is the team we've built. And it's because I got to work with these people like 60, 70, 80 hours a week. That's more time than I'm spending with my wife. That's more time than I'm spending with my family. That's more time than I'm spending with my friends. It's more time than I'm spending with myself. So these people are really freaking important. And fortunately, they lift me up. They teach me. It's their networks to whom I'm exposed. It's their reputations that become my reputation. So think about that a lot as you look at job opportunities from here on out. The people you work with will determine your happiness, they'll determine your reputation, they'll determine your learning and your learning curve. It's really, really key. So that's criteria number one that should trump all the other criteria that you might consider. Criteria number two, growth. Growth of the industry, growth of the organization. If the industry's growing, there's more opportunity. You can be like I was when I was in my 20s, I was in a growing company, in a growing industry, and I was like managing people 2 decades older than me. I'm 40 now, and I'm running a pretty cool company. Used to be reserved for people with gray hair, and I've got a couple of gray hairs, but not too many yet. Growth makes that possible, right? Growth creates opportunities for us. Whether the organization or the industry is growing, that should be a key criteria for you. And in the resource revolution, we're talking about super high growth. There's growth in new solutions around energy, new solutions around food, new solutions around water, new solutions around land management, all sorts of areas, waste. So there's a lot of growth happening, and that offers you a lot of opportunity. So that's my unsolicited career advice. That's sort of the end of my little discussion here today. But the resource revolution is truly about economics. It is truly a set of opportunities that all of us could go into and make a real big difference and make a lot of money. And it is also a place where you can be really thoughtful about how you chart your course. My course sounds like it was very linear and logical. It wasn't. It's just how I tell the story. And a lot of it is how you tell the story. And what is the story that you want to tell 30 years from now? That should probably be the biggest factor of all. So thanks for letting me be here.
Excellent, Scott. Thanks for a great kickoff. I'm Greg Dalton, and let's talk about, you talked about the people you work with, the importance of the team. I'd like to hear about some mentors that you've had that have been really influential in the journey you talked about.
Yeah, it's interesting. Obviously, as I said, the people are such a key part of the career. I remember when I was at HBS and trying to figure out what I would do in this whole clean energy ecosystem, I was lucky enough to contact some other HBS alums, one of whom is a guy named Raj Atliru. Raj was the head of the clean tech practice at a firm called Draper Fisher Jurvetson, a venture firm. He's maybe the only venture guy that has a positive track record investing in clean tech. He invested in SolarCity, Tesla, Enernoc, all sort of like in their first rounds. He was incredibly generous with his time. He didn't really know me or anything. He picked up the phone because he was willing to talk to another HBS kid. And I went to India for Sequoia, and Raj sent me to a bunch of his contacts and companies. Raj invested in Generate in our first round, and he's on our board, and he's been tremendous. He's probably the person I would call the most important mentor in my life. There's another person I mentioned
Let me just put on that. That first call, did you call and say, hey, will you be my mentor?
No.
Okay. Because I want this much of your time and this much guidance on my life. It more evolved.
Yeah, I mean, when I was in tech and I was like running tech companies at age 24, like I didn't have mentors. There was no, I mean, I didn't even know what I was doing. But there weren't people to mentor me. And so I wouldn't have even known how to ask someone to be a mentor or even what it was like to have a mentor. Mm-hmm. And so, no, my question to Raj was, hey, I'm thinking about clean tech. Can you like spend some time telling me why you're doing it? And we got to know each other over many years, and we've become very good friends. I'm helping him fundraise for his fund. He's a tremendous person. Yeah, it's not something that is as explicit as that. And now that when I'm introducing him to people that I've raised money from, and he would like to raise money from, it's pretty gratifying to type the email and say, this is my board member, this is my friend, and this is my mentor. And I can't say, I couldn't speak more highly of anyone on earth. And so most people will take that call and meet with him. And so there's some reciprocity.
How about leaders that are not your mentors, but you look to, that you respect, or who are sustainability leaders in this resource revolution? Who are some people that these students could look to as like, okay, person to follow?
Yeah, I mean, everybody answers Elon, obviously. I mean, I do think he's a visionary, and it's wonderful what he's doing, and he's challenging the status quo in so many ways.
But it's not a person you're going to emulate, right? I mean,
no, but you could do a lot worse, right? No, actually, the people that are the most inspiring to me as leaders in the resource revolution are the people we work with every day, the project developers. They're these, you would never have heard of any one of them. But they are out there, busting their butts trying to make a project happen. Either here in North Carolina with solar, or anaerobic digestion and sort of dealing with food waste and things like that. We've been active here in North Carolina. There are people all across the country. They're, mom and pop entrepreneurs, but they're not. I mean, they're doing amazing work. They're finding the land, and they're talking to the utilities and getting a contract, and then they're, hiring an engineering firm, and then coming to talk to us to raise money for the project, and they're scrapping and clawing and scratching, and they're scrappy, and I have a ton of respect for hustle and scrappiness, and I think those are the entrepreneurs that inspire me the most, and that's what we need a lot more of.
And you talked about Jigar Shah, his innovation, moving CapEx to OpEx, and really unlocking financing in solar. Yet SunPower, the company he founded, went bust.
SunEdison, yes.
SunEdison went bust.
Far after he left.
But what's the cautionary tale there of SunEdison going bust?
So I think SunEdison is just another in a litany of examples where profitability was not as much of a concern as growth. And it goes back to the short-termism point that I made earlier. When you have owners that want to make a bunch of money in a short period of time, usually venture capitalists, private equity firms, even public stock investors, the short-term time horizon forces you to focus on growth, because growth is what gets you to sell the business at a high price or a high multiple. And so you grow really fast, and you've seen this happen in clean energy, you've seen this happen in dirty energy, you've seen this happen in tech, you see this everywhere. But when you have a short-term orientation, you drop your price in order to get more growth, right? And that means you have slimmer margins, if margins at all. And so you're trying to grow as fast as possible, you don't care about profitability, and you're owned by folks who don't want to dilute their ownership stake because they want to hold on to it, right? So in holding on to it, they'll substitute what should be equity capital with debt capital, especially in a cheap credit market like we're in right now. So they'll raise a bunch of debt. And so then, the equity is pretty risky, right? Because you've got a bunch of debt above you, and you aren't making margins. And so it might work in 3 years. You might get out, and it's somebody else's problem. But most of the time, it doesn't work. And you have a little hiccup in your customer acceptance, or you have a little hiccup in the capital markets and you're hosed and you're out of business. And it's greedy and it's short term. And if you think about infrastructure, you shouldn't be thinking short term. These are assets that live 20, 30, 40, 50 years. So you have to think very differently about it. And I could go into my spiel about how we have built this business from the ground up to be really, really long-term oriented. And we've never made these sacrifices for the short term. We've never sacrificed profitability for growth. And we won't, as long as I'm in charge. And that's the key to thinking a little bit differently about how to do this stuff.
Yeah, well, Amazon was built in a similar way, very long term, not regard to margins in the short term. People think about innovation, Silicon Valley, where we live, they often think about debt, about equity. Yeah. But the reality is, in clean energy, most of the action and the deal flow is on the debt side. So tell us about how debt can be as sexy as equity.
It's not sexy. It's like all you care about is getting your money back. That's not that sexy. So I think Bloomberg New Energy Finance is probably the authority on capital flows in new energy. And for about 10 years, we've had about $300 to $400 billion a year going into clean energy. And it's always the sexiest thing to talk about venture capital, because those are the Elons of they're backing the Elons of the world. At its peak, venture capital was 6 out of that $300 billion. What's that, 2%? Most of that $300 billion is asset finance. And we'll hear from one of the big banks involved in asset finance. We do project equity, not debt so much, but we do lend as well. But the bulk of the capital flows by far are debt capital flows. And it's not sexy in terms of the security interest or the underwriting, perhaps. It is boring. And as Jigger likes to say, it's simple but not easy. And it is simple. It's like, do you have long-term contracts with creditworthy counterparties with a proven solution? That'll get you money. And the reason why you need it not to be sexy, you need it to be boring, because you need the capital to be cheap. Debt capital is cheaper than equity capital. And you need a lot of capital. And you need it to be mainly debt, and you need it to be cheap. So it needs to be safe, not sexy. And that's really a key lesson learned from the sort of difference between invention and infrastructure.
And a lot of entrepreneurs like to go into areas that are not highly regulated, that are not dependent on policy, which they can't control. A lot of VCs talk about, we won't make a policy-dependent investment. And yet, you're making a pitch here for going into realms that are policy-dependent and highly regulated. How do you make that case to people why they should go into something versus the internet, which is wild and free?
I'm not sure the internet is wild and free anymore this week. I would say, so it's funny, VCs especially were always reticent to go into any sector where there is a heavy regulatory component to it. And the reality is energy and resources are always going to be regulated. They're public goods. They are absolutely critical to the economy, and we are not going to stop regulating those things in my lifetime, I don't believe. You have to understand the policy environment, and the policy environment can be both favorable or unfavorable, and it's at a very local level that is determined. Tech is no longer unregulated, and certainly looks a lot more risky from a regulatory standpoint this week than it ever has. But look, the fact of the matter is that energy and resources involve, just like anything, a lot of different actors coming together. You need not only the policy environment, you need markets, you need innovation, right? And you need capital. And in China, it's nice because top down, all 4 of those things come together perfectly because they just decide. But here, and in most of the more sort of free market capitalist places, you have to actually do some work to make regulators talk to innovators, talk to market incumbents like GE, and talk to finance providers like JP Morgan or risky equity people. And that's hard. In fact, I think that was part of why we were so successful at McKinsey, was we were able to convene those conversations and create a common language for those different actors to speak. Because DC does not like Silicon Valley, and DC does not like Wall Street. And Schenectady, New York doesn't spend a lot of time in Silicon Valley either. And so they actually speak different languages, right? But we created this common language of economics and said, look, this is just about risk. This is just about reward. This is about, unit economics. And if you start sort of dealing with first principles, you can get people to see the facts.
Energy is thought of as to be a boys' club, and you've been noting some interesting changes recently in terms of the gender composition of what's happening, the innovators you're seeing. So tell us about that.
Yeah, I mean, one of the things that's really cool about this industry is it's not as much of an old boys' club as some of, like when I was in tech. I mean, it was like 90% dudes, and I go to these events for sustainability, and it's a much more interesting group of people. I always used to say that, when I would go to an event in tech, I knew that I was in the wrong industry because I just didn't really want to hang out with the people that were going to these conferences. They're nice people, nothing wrong with it. But they just weren't me, they weren't like my people, you know what I mean? In sustainability, I find like, these are my people, And I like going to these events. We're talking about like solving big problems in the world. We're talking about creating new solutions. And it is a more diverse crowd. It's definitely more gender balanced. We have a CFO who's a woman, and we're very balanced from a gender standpoint at our company. But it still takes, I think we're seeing the next generation being a lot more interesting and diverse than the old gray-haired white guys that have occupied the corporate offices. My mentor at McKinsey used to say the most important thing you need to know about the energy system is the number 62. Anyone want to know why? Or does anyone know why? I mean,
Retirement age?
It's the average age of the CEO of an investor-owned utility. So they're retiring in 3 years, and they're not going to do anything that puts their pension at risk.
Can ask Jim Rogers later on.
Jim might have something to say.
We'll get Jim's point on that later. How much can the Trump administration slow down or dampen the things? What's being driven? How much is the market taken off, and how much of this can be slowed down?
So I think there's always a bit of a. I think we tend to put all of our hopes in the federal policy arena for like a carbon tax and whatever, and we also put all of our fears into the DC politics. And the reality is that most of the stuff that has moved clean energy has been at a much more local level. The renewable portfolio standards at the state level have been a big driver for renewables adoption. California being a leader, New York being a leader in these things. And then even at the city level, we're seeing a lot more happening, thanks to mayors and cities. Mm-hmm. So, Trump has, it's a lot of noise. It's a lot of noise, but it's not a lot of action with respect to our stuff. Like, it's not really affecting renewable energy development. It's not really affecting landfill diversion, which we are, seeing happen a lot at the city and state level. It's not affecting. There are big impacts that the federal policy could do, but. CAFE, for example, if you think about transportation, the corporate average fuel economy is probably the single biggest thing that will affect the greenhouse gas emissions in the United States, driving up the fuel economy of the vehicle fleet. And that was done under Obama, and that was a huge, huge thing. And so he could have a really big effect by retreating from those goals, which he has threatened to do. But in the sort of stationary energy space and in food and water, the federal administration has a lot less to say.
And the investment tax credit and the production tax credit made it through in the tax bill, partly because there's a lot of bipartisan support. Yeah,
I'd love to see all those subsidies, both for clean and dirty energy, go away, and we would win on economics alone. I'm a little bit controversial with that view. I don't think we should have ITCs, but I also don't think we should subsidize oil and gas 6 times more than we do renewables. So, let's see a level playing field. That would be nice.
Well, we have to wrap it up, but if you'd like to hear more about Scott, you can check out what Scott's thoughts on tariffs and other things. I'm sure they're on the front of your mind. You can check him out on the Climate One podcast, where he was recently with Lynn Jurich, CEO of Sunrun and others. So we have to wrap it up there. So let's give a hand to Scott for opening us up.